What happened when the last time they increased the capital gains tax? Do you remember? The market went up 30%. So let's dive into this. So let's start looking at the data for capital gains tax rates relative to ordinary income. And we'll start in 1960 under John Kennedy. Because remember, Kennedy was a tax cutting Reaganite, essentially. Anti-commie, wanted low taxes. And you can see here the highest income rate was 70%, where the maximum capital gain rate was 25%. Interesting. So the 60s, the market do great, not from 66 to 82. So if we have, here's the Reagan tax cuts right there. The federal I forgot what it's called, the tax, TRA, TEFRA, I can't remember. But anyway, there's Reagan's tax cuts. Oh, and there's the capital gain tax rates, which are higher than what they were in 1981. So realized gains were taxed as the same as other income under the Reagan era. Kind of interesting. Then there's stupid George Bush's ordinary income tax rates at 31.9, but there is the capital gains rate. So from 1982, the capital gains rate started. Remember, 1982 to 1999, the markets did incredibly well. The capital gain rate was 20% in 1982 through 1986. All right. Then it went to 28, 29. 30, went back down in 1997. Interesting, but it did go up, did it not? Yes, it did, my friends. The capital gain rates did. It started at 20%, then it went up all the way to 29.2 under Clinton, then it went back down to 21.2. Pretty interesting, huh? The highest, your highest income rate was going up too, but even that was lower than previous as well. So what happened was when Reagan took office, capital gains rates, or when Reagan got his first tax bill passed in I can't remember, but anyway, he had one thing, I think it's 1982, the Tax Reform Act. Ordinary income was taxed at 50%, capital gains were taxed at 20%. By the time Clinton was done, all right, ordinary income was taxed at 43.7%, capital gains rates were at 21%, but capital gain rates had actually gone higher even during that time frame too. Pretty interesting. And ordinary income rates went down too. And yet, did the markets get killed? No. All right. So then Obama raised capital gain rates from 15 on the maximum capital gain to 25. We take our choice in conculator. That's a 10% rate, but it's even more than 10. That's a 66% increase in the maximum taxable capital gain rate in 2013. All right. So it went from 15 to 25. 66% increase in capital gain rate. And income went to 44.6%. All right, you with me so far? Income, that's the highest income tax rate. So 66% increase in capital gain. What was the increase in ordinary income rates? Went from basically 38 to 40, we'll just say 45, about 7% divided by 38. It went up 18%. Capital gain rates went up by 66%. Income rates went up by 18%. And what happened to the markets in 2013? Well, let's take a gander, shall we? We'll go back to our thing from old Dan Coolbert, and we'll look at his markets, and we're going to go back and see what the S&P 500 did in 2013. Let's take a gander. Let's gander with me, all right? I don't like you saying those words, Josh. I don't like your attitude. That's okay. That's okay, my friends. And there's Finney. You can talk to him. All right, so in 2013, here we go. What did the S&P 500 do? Oh, look at that. 32%. Interesting. The following year, 13. The following year, 1. The following year, 11.9. The following year, 21.9. The following year, negative 4.4. The following year, 31%. Not too shabby. Not too shabby if you do say so myself. And then if we go back I can't remember what it did in 2020. I forgot. It was up, 18% or something like that. So you can see right here, according to Katie Greifield, Wall Street got stimulus and now it's hearing about the bill. A glow after trillions of dollars of government spending pushed markets to record after record in the first part of the year. The securities professionals reacted cautiously to Sniffy Joe's proposal to raise the taxes on investing profits. Many counseled calm. pointing to the likelihood of long negotiations, while noting the plan also had the potential to provoke preemptive selling, cut stock valuations, and slow down the rally. Stocks buckled in the aftermath of Bloomberg's report that Sniffy Joe planned to raise the capital gains on the wealthy. With the S&P falling as much as 1.2%, oh no! Still, the decline was minor next to the index's 85% over the last 13 months. And most institutional investors saying they wait to see how the bill progresses. The Biden news shouldn't have been a surprise on Wall Street. It's the same increase laid out on platforms during the presidential campaign, and copious analysis have been published prior to Thursday. Goldman Sachs strategists wrote as early as October that said raising the rate would be a minor speed bump for the upward trajectory of stock prices. Right? History shows stock prices fall, equity allocations decline, and momentum underperforms ahead of increases in the capital gains rate. However, any potential equity selling will be short-lived and reversed in subsequent quarters. Logically, Goldman Sachs said stocks that have gained the most may get hit the hardest. Well, that makes sense because that's where the selling would be if you got to sell. While when capital gains were last raised under Obama, 2013, the wealthiest 1%, unsurprisingly, were the biggest stock sellers. Still, if investors were penalized by that hike, it did not show in overall returns. The S&P 500 rose 30% that year, the best gain in almost a decade. Goldman estimated in October that the top 1% holds about $1 trillion of unrealized gains. In 2013, that cohort sold 1% of equities of their starting equity. They sold 1% of their starting equity assets, which would equate to about $100 billion in selling. The group then turned around and bought the equivalent of 4% of holdings once the tax took effect, more than offset the selling. The capital gain tax rate is a variable in a model tracked by Keith Parker, who's head of U.S. equity strategy at UBS. Historically, when the tax rate changes, so does the multiple in the S&P 500. The new proposal could mean a 7% hit to the price-to-earnings multiple. That's because a higher rate could dull sentiment towards stocks. Or if you do have a sell, what would that do to PE ratios? It'd knock down the price. Earnings don't get changed. Think of it as you're paying a price for which is pre-tax, and you get after-tax returns from either selling or a higher dividend, selling at a higher price or dividends. Okay. Anyway, there you go. So please stop this idea that a raising of the capital gain is going to destroy capital accumulation. It's just, why is my shirt inside out? Because it's out in the garden once again. All right. So you do what you got to do. You can sweat it. You can go, oh my goodness. But man, at the end of the day, the government spending has given the richest of the rich a big boost in their portfolio. Yes, we have all benefited. I'm not going to lie to you. But if you're 1% and you're holding on $1 trillion of unrealized gains, it might be time to offload a little bit to pay some of the taxes for the government largesse that you've certainly been benefiting from. Will that kill the rest of the middle class investors? There's no evidence of that at all. All right, we'll see you.